Did you know that the average American has less than $100,000 saved for retirement? And even worse, nearly 40% of Americans have no retirement savings at all. Yet, some investors have turned small amounts of money into millions, just by following a few simple strategies. You might be asking, how? The answer is value investing. In this video, we're going to show you how the world's most successful investors, like Warren Buffett and Benjamin Graham, made their fortunes. You don't need a finance degree or insider information. All you need is the right mindset, the right strategy, and a little patience. The path to $1 million is closer than you think. In the next few chapters, we'll cover powerful techniques that can help you grow your wealth over time. You'll learn how to spot undervalued stocks, how to use compound interest to your advantage, and how to stay calm when everyone else is panicking. Ready to take control of your financial future? Stick with us, and by the end of this journey, you'll have the roadmap to reach $1 million and beyond. Let's get started. Chapter 1. Unlocking the treasure map. The core of value investing. Value investing isn't about chasing trends or trying to time the market. Instead, it's about finding stocks that are priced below their true value. The idea is to buy these stocks when they're on sale and hold them for the long term. As Warren Buffett famously says, price is what you pay, value is what you get. In the world of investing, finding this value requires digging deep into a company's fundamentals. The first step in value investing is understanding a company's intrinsic value, its true worth, based on earnings, growth, and risk. Intrinsic value is different from market value, which is the price the stock trades for in the market. Often, the market misprices companies, and this is where you, as a value investor, find opportunities. Benjamin Graham, the father of value investing, introduced the concept of margin of safety. It means buying a stock at a price significantly lower than its intrinsic value, providing a cushion against market fluctuations. For example, if you estimate a company's intrinsic value to be $100, and the stock is trading at $60, you have a $40 margin of safety. This cushion protects you if your analysis turns out to be incorrect. Understanding a company's financials is crucial. Look at earnings, debt levels, and cash flow to gauge its financial health. Graham suggests that investors should focus on companies with a strong balance sheet, ones with low debt and consistent earnings growth. Avoid speculative stocks that rely on future promises without real earnings. Stick with businesses that have a solid track record. While other investors chase hot stocks or follow the crowd, a value investor takes a different approach. They focus on solid companies that are temporarily undervalued, often due to market pessimism. This strategy might not offer quick gains, but it pays off in the long term. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Chapter 2. The magic of compound interest. Your silent millionaire maker. The real power behind investing isn't just picking the right stocks, it's letting your money grow. This is where compound interest works its magic. Simply put, compound interest is earning interest on both your original investment and the interest it has already earned. Over time, it turns small amounts of money into huge sums. Consider this. If you invested $1,000 at a 10% annual return, you'd have $1,100 after the first year. The next year, you earn 10% on the new total of $1,100, making your balance $1,210. By the 10th year, that $1,000 would have grown to about $2,593. It's incredible how small growth over time can multiply dramatically. Buffett himself has often credited compounding as a key reason for his success. He once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." But here's the secret. This magic works best when you leave your money alone for long periods. Investors who pull out their money too soon miss out on the power of compounding. Don't just focus on returns, focus on reinvestment. A good strategy is to reinvest your dividends. This turns dividends from small payouts into large growing sums. In fact, between 1930 and 2019, the S&P 500's total return, including reinvested dividends, was about 9.6% annually. Without reinvestment, the return would have been much lower. In real life, compound interest helps value investors grow their portfolios without constantly having to make risky bets. It's not about getting rich overnight but letting steady, consistent growth work in your favor. The longer you stay invested, the more powerful compounding becomes. Just ask Albert Einstein, who called compound interest the eighth wonder of the world. Chapter 3. The Underdog Portfolio. How to find hidden value. One of the most exciting parts of value investing is finding underdog stocks. These are companies that are undervalued by the market, but they hold real potential for growth. Finding these opportunities takes patience and research. It's about looking deeper than the surface level and understanding what the market is missing. The first step is to look for companies with strong financials but low stock prices. These could be companies that have been overlooked or underappreciated, often due to short-term setbacks. For example, during the 2008 financial crisis, many high-quality companies saw their stock prices drop, but their long-term prospects remained strong. This is where value investors can swoop in and pick up bargains. Next, you need to assess whether a company has a competitive edge. A company with a strong brand, unique products, or a loyal customer base is more likely to survive market downturns. Think of companies like Coca-Cola or Johnson & Johnson. Their strong positions in the market have helped them weather tough times, making them reliable long-term investments. Another critical factor is the company's management team. A great company needs great leaders. Research the CEO and management's track record. Have they made smart decisions in the past? Are they committed to shareholder value? These are signs of a company that might just be worth investing in. Lastly, consider the industry in which the company operates. Is it growing or shrinking? Companies in growing industries, like tech or renewable energy, have more room for expansion. But don't overlook companies in mature industries that are still able to innovate and maintain profitability. Finding these underdogs takes time, but it's one of the most rewarding strategies in value investing. When you discover a hidden gem, it can lead to outsized returns. Just remember, value investing is a long-term game. Don't expect instant results, but if you stick with it, the rewards can be substantial. If you're enjoying this content, don't forget to subscribe for more tips on value investing. Chapter 4. The Danger of the Herd. Avoiding common pitfalls. In the world of investing, it's easy to fall into the trap of following the crowd. When everyone is excited about a stock, it's hard not to jump in. But as history has shown us, following the herd often leads to poor outcomes. The key to value investing is resisting the urge to buy into hype and instead staying focused on fundamentals. One of the biggest dangers for investors is market psychology. During times of market euphoria, like the dot-com bubble or the housing market boom of the mid-2000s, stock prices get disconnected from reality. Investors pile into the market, pushing prices higher, without considering the underlying value. Eventually, the bubble bursts, and many are left with massive losses. Benjamin Graham, the father of value investing, often warned against emotional investing. He called this the Mr. Market concept. Mr. Market is a hypothetical character who swings between extreme optimism and extreme pessimism. Sometimes he offers you a great price for a stock, and other times, he offers a terrible one. But as Graham advised, you should ignore Mr. Market's moods and make investment decisions based on the fundamentals of the company, not its market price. To avoid these common pitfalls, investors should focus on long-term goals and not get distracted by short-term market fluctuations. According to a study by Dalbar, the average investor's returns have historically lagged behind the market by 4–5% per year due to emotional decision-making. By staying disciplined and not reacting to market noise, you can make more rational, sound investment decisions. Contrarian investing, buying when others are fearful and selling when others are greedy, has been a proven strategy for many successful investors. Warren Buffett is a perfect example. He has famously said, "Be fearful when others are greedy and greedy when others are fearful." By acting counter to the herd, you can often find great investment opportunities that others overlook. Don't miss out on more valuable investing tips. Subscribe now to get the latest insights straight to your feed. Chapter 5. Patience. The slow burn rocket fuel for your portfolio. One of the most critical elements of value investing is patience. In today's fast-paced world, where people expect instant results, it's easy to forget that true wealth takes time to build. This is where the power of patience comes in. Investing is a marathon, not a sprint, and the long-term investor has a significant advantage over those looking for short-term gains. As Warren Buffett has said, the stock market is designed to transfer money from the active to the patient. The key to building wealth through value investing is giving your investments the time to grow. The longer you hold a quality asset, the more time it has to compound, even through market volatility. A study by Hartford Funds found that the S&P 500 index returned 10.2% annually from 1926 to 2019. But if you missed the best 30 days of performance in those years, your return dropped to just 5.6%. Patience also means not being shaken by short-term market movements. During times of economic downturns or market crashes, the temptation to sell in fear can be overwhelming. However, if you've invested in solid companies with good fundamentals, these downturns are just temporary setbacks in the long-term journey. It's important to remember that market cycles are natural, and stocks tend to recover over time. Take the example of Coca-Cola. In 1988, the stock was down 25% over a span of just a few months, but over the next 30 years, it grew by more than 5,000%. Investors who sold out of fear missed this huge opportunity. The lesson here is that short-term volatility is a normal part of the investing process, and long-term gains require you to stay patient. Similarly, if you're investing in dividends, patience can be particularly rewarding. The more time you allow for dividends to reinvest and compound, the bigger your return will be. A long-term focus is crucial to maximizing the benefits of dividends, and it can turn small investments into large sums over time. By staying focused and patient, you'll be able to weather the storms of market fluctuations and come out ahead in the long run. The key is to buy strong, fundamentally sound companies and hold them for years, not months. With time, your patience will be richly rewarded. Chapter 6. The $1 Million Blueprint. Building your roadmap to wealth. Now that you understand the core principles of value investing, it's time to put it all into action. Building a roadmap to $1 million requires strategic planning, discipline, and an eye for undervalued opportunities. The first step is to start early. The earlier you begin investing, the more time you have to let compounding work its magic. Starting at 25, for example, can give you decades of growth before you reach retirement age. A smart starting point is investing in low-cost index funds. These funds track the performance of the broader market, and they're perfect for investors who want a diversified portfolio without having to pick individual stocks. Over time, as your understanding of value investing grows, you can start to incorporate individual stocks into your portfolio, but the index funds will provide a solid foundation. When you begin selecting individual stocks, focus on companies with strong financials, a track record of success, and a durable competitive advantage. These are businesses that are likely to stand the test of time, even through market downturns. Companies like Apple, Microsoft, or Berkshire Hathaway are examples of such firms. These companies have proven their resilience, and their stocks have provided excellent returns for long-term investors. Next, use the strategy of dollar cost averaging. This means investing a fixed amount of money at regular intervals, no matter what the market is doing. This strategy helps to smooth out market volatility and ensures that you're consistently adding to your investments. It also removes the need to time the market, which is nearly impossible. As your portfolio grows, it's important to reassess it regularly. Look at your stock picks and make sure they still meet your criteria. Over time, industries change, and companies can decline. Staying proactive and adjusting your portfolio to reflect new information will help keep you on track. Diversification is another key element. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes, such as bonds or real estate. A well-diversified portfolio can reduce risk and provide more stable returns over time. Reinvesting dividends is a powerful way to increase your wealth without having to do anything extra. As your portfolio grows, those small dividends can add up significantly. The more you reinvest, the faster your portfolio will grow. Finally, never underestimate the power of keeping your costs low. High fees, whether from brokers or funds, can eat into your returns over time. Choose low-fee investment vehicles to maximize your growth potential. Even a small difference in fees can lead to large differences in your portfolio's value over decades. By following these steps, building your $1 million portfolio becomes achievable. The key is staying disciplined, patient, and focused on the long term. Value investing is a journey, and with the right strategy, you'll be well on your way to financial independence and success. Remember to subscribe for more valuable content that will help you become a smarter investor and reach your financial goals.